Welcome back to Click Capital, your go-to channel for all the latest market data analysis and charts. And we had another pretty good day out there, finishing green pretty much across the board. And this is a weekly chart of the SP500, and you can see we're tracking to have our fifth consecutive week where we close higher. But we're sitting smack bang in the middle of this big resistance zone around 41.50. So this could be an area where the market starts to stall out and turn. However, we'll come back to the charts in a bit after we go through the data like we normally do. So you can see on the heat map here, it was pretty green today, especially mega cap tech. We had that lower PPI number come in, which the market loved. The only sector that was really green was real estate. The defensive sectors like utilities, consumer defensive were a bit weaker. Now, when some pretty big moves like Amazon up 4%, Disney up almost 3%, Netflix over 4%. However, NVDA diverged from the group and that actually finished down slightly, which I'll get into on the charts in a bit later. And just before we move on with our daily analysis and review, I just wanted to take a quick minute to tell you guys what separates us from other YouTubers out there, because I know you've got a lot of choice with who to watch for your daily market analysis and charts. And I don't want to go too much into what others are doing out there. However, I will say that we actually trade and manage client portfolios instead of just playing around with charts. And this is our strategy here, equity long short on Collective 2. For those of you who don't know, Collective 2 is like an online strategy marketplace where you can follow strategy managers like us and copy all our trades in real time manually, or you can pay a little bit extra and have them automatically traded in your Interactive Brokers account. And these results you're seeing here are all independently verified and include broker commissions and the cost to follow our strategy, which is $99 a month. And since we started on the 1st of December, we're up 18.4% when the market's basically flat. It's gone up just a little bit in that same time. And we've done that with less risk as well. Max drawdown of 6.7% versus almost 10% for the market and a Sharpe ratio of 3.2. And how we do that is we always carry a portfolio of 10 stocks long and 10 stocks short, evenly weighted at 7.5% each. So that's total leverage of 150%. 1.5, and our correlation to the market is actually negative 5%. So what that means is you're getting returns that are completely unlike the market. And everything you hear me talk about on the channel, like being long commodities and gold, I express that macro view in the portfolio that we actively monitor every day. So we're really well positioned going forward for the commodity bull and an upcoming recession on the short side of our portfolios. We have a lot of cyclical high beta stuff that's still really overvalued, and we're currently close to breaking out to all-time highs again today. So anyone can follow our strategy. You've got the link down below this video, and it's just $99 a month and you'll get all our trades in real time sent to your email. Or like I said, you can pay a little bit extra to Collective 2 and have the trades automatically traded for you in your Interactive Brokers account. So if you're struggling to beat the market with less risk, I highly recommend you check this out. I also want to add on Collective 2, there is over 1,000 systems available there. You will find some that do have higher returns, but I encourage you to pay attention to the leverage number. As we only use 1.5 or 150%, you'll find some systems, they may show big returns, but they're putting half their account into one position or shorting small stocks or highly leveraged futures positions. We only put 7.5% of our account into each position, and we're trading large liquid stocks. And in my opinion, anytime you use more than 2 or 200% leverage, it's just a matter of time before the strategy will blow up. Because it doesn't matter how uncorrelated your trades or how sure you are or the stop loss, that'll eventually blow through a stop or the trades will become correlated. And when you have a leverage higher than 2, it becomes a real slippery slope, in my opinion. So we've achieved these good returns only using a modest amount of leverage, whilst always keeping the portfolio market neutral with equal amount of longs and shorts. So again, the link to the strategy is below this video and I encourage you to check it out. All right, let's keep going with the daily review. So with economic data, we saw the producer price index come in a bit lower than expected today. Actually dropped 0.5% month over month. So that's the prices that producers pay for commodities and stuff. So that's pointing to signs that inflation may be tapering a bit here. And we got the weekly jobless claims came in a bit higher than expected as well. Not by much, but it could be another sign that the job market could be starting to turn a little bit. And tomorrow we got those retail sales and bank earnings, so it should be a good day going into the weekend. And I think a part of today's rally is not only that PPI, but we've recently got record net short positions in S&P futures to the tune of 321,000 contracts. Now that's the biggest it's been for many years. And there could be good reasons for why they've got short. However, whenever the market finds itself cornered like this, it can be liable to go in the other direction. As I speculate, some of the largest hedge funds out there that I won't name tend to use positioning, and I'm pretty sure they use retail positioning as well, to kind of push the market the other way and squeeze a few stops and get a bit of an unwind in the direction that they want. So this is something I'll talk about a bit more when I get back to the charts later, but I think we could be pushing a little bit higher here, squeezing a few shorts. However, I think these shorts have strong fundamental macro reasons for getting short. So I still think the market medium term could be setting up for a short. We just might be getting a little bit of a short-term squeeze higher here. And we can see that in the fear and greed index now at 62 and pretty elevated and around levels where we typically see short-term market tops. Dark pool index is at 46%, which is just slightly bullish and slightly supporting the market here. But still, that's diverged with the market that's gone up the last 5 weeks. The dark pools have come off a bit. Still no love from corporate insiders either. They're not really buying this market up here. They're actually ticked up with the amount of sells they did yesterday. Option market was a little busy today with 34 million contracts being traded, 55% of them calls, and just seeing those low put percentages in the mega cap tech, everything except NVDA. NVIDIA's keeping those high puts. I think a lot of people still loading into NVIDIA puts, 55% today. But if we look at Meta, 39%, Amazon 31%, Apple 48%, Microsoft 44%, Netflix 44% as well. So these mega cap names, people are still loading into the calls on them or not buying puts or a bit of both. Interestingly enough, on gold as well, 42% puts, and gold miners 18% puts. And we did see the price of gold break out today, so I think people are starting to increase their allocations to gold and jump on the gold bull train, which is good for people like my clients and me who are already well positioned in gold stocks long. And even though the stock market apparently got excited today with that lower PPI number, we didn't see the same sentiment in bonds. In fact, the probabilities of a rate hike only decreased marginally, and still at a 2/3 chance that we're going to get a hike at the May meeting. So once again, it looks like the stock market is getting a bit ahead of what the bond market is saying. And in today's interesting chart, this is a chart of bankruptcies from public companies with assets or liabilities greater than 2 million, or private companies with assets or liabilities at the time of bankruptcy filing that are greater than 10 million. And you can see already year to date, March 31, we've had 183 bankruptcy filings. That's the biggest since the hangover from the GFC in 2010, where there was 255. And you can see that trend on the bankruptcy filings by month has been increasing since mid last year. So again, just another sign pointing towards an upcoming recession in the economy. Okay, that's it for data today. Let's head on over to the charts. And if this is your first time here, welcome. My name's Jared from Click Capital. And each day I go through the same process to review the markets for you and show you all the most important data and charts and give you my analysis and take on it. And I'll also share with you my opinion on the short, medium and long-term forecast. So whether you're a day trader and trying to get a feel for the type of market we're in, or a long-term investor, I'm sure you'll find value. And if you follow this process with me every day, you will find after a while that you start getting a feel for the market. And I've found that can help make much better trading and investment decisions. Okay, let's get stuck right in. So the SP500 actually broke out to multi-week highs here, finished at 41.46 in this big resistance zone that we've been watching, but on low volume. So volume starting to wane, getting a bit of a volume divergence here. Got a little bit of a divergence on our hidden divergence indicator as well. However, tech stocks were the winner today. The Q's up almost 2%, but they haven't managed to find new highs either. And we did get a little bounce out of smalls, which have been really depressed, and they closed over their 50. And just a note, I refer to the 50 as the 50 bar VWAP. But we'll come back to the main indices at the end of this video, and I'll give you my final opinion like we always do. And so we follow the international indices because we like to look at global equity breadth. As we live in a synchronized world now, everything kind of moves like a big school of fish. And we can see all indices kind of acting the same, kind of hovering, consolidating around their tops here. We've got the Canada TSX, the English FTSE, the German DAX, the Japanese Nikkei, the Aussie consolidating, and China just kind of sitting under its 50 as well. Over to volatility land, and again, volatility just been sucked out of this market. We've got a VIX now at 17.8, and just out on the weekly chart for you, apart from a brief dip here in late January this year, we're coming back down to levels not seen since before the start of the bear market in January last year. So at the start of this month, I showed my viewers strong seasonality, bullish seasonality for the month of April, and that's looking to be playing out. And we've got option dealers here basically saying the implied volatility is at 17% annualized. So they're saying there's just not much volatility coming up in the stock market. And we can see that in actual realized volatility in the SP 500. It's tracking at an annualized rate of 15%. So the volatility risk premium is just 2.6 points, which means the VIX is 2.6 points above realized volatility. So again, this market's just trading really flat and slow, and we're seeing that in bonds as well. Move index came off today to 119, and put call ratio at 0.85. Not many people buying puts out there, so not a whole lot of fear, and there's actually more greed in the market at these levels. However, in contrast to the overall volatility market, is we've got the skew index moving a little high here, and this basically measures tail risk in the market. That's the premium of out of the money put options on the S&P versus the implied volatility of at the money put options. So we can see the premium for puts is actually starting to grow. So even though there's not a whole lot of people buying puts, the amount of people buying out of the money puts, maybe buying some insurance tail risk hedging, is actually increasing. Over to breadth, and the amount of stocks above their 20-day average sitting at 82%, so still elevated up here with the market. But again, this is a level we typically see short-term market tops. And interesting to note, 109 ETFs made new highs today. And last time we saw that was actually on Feb 2, which was a bit higher at 132. And that's when the market last topped actually. And in stocks, only 43, 47 stocks on NASDAQ made new highs today. So not really high there. Over to spreads, and the growth cyclical sectors versus defensive sectors still sitting under their 50 here, a little bit depressed. Did see a slight bump up in high beta stocks today, and growth stocks as well, still in an uptrend versus value stocks, as are NASDAQ stocks versus SP, and small stocks still really depressed here versus big stocks. International stocks still holding pretty well here versus American stock. We saw European stocks break out yesterday versus American stocks, and volatility in the yield curve and bonds has really dampened down here. Got high yield actually back above the 50 versus treasuries. And inflation expectations, as measured by inflation protected treasuries versus normal treasuries, kind of tracking a bit sideways here. And the 2-year sitting pretty flat here. Like I said, the stock market apparently got more excited about the PPI than the bond market. If the bond market really interpreted that lower PPI reading as the Fed going to pause and reverse, it would have come off a lot more than it did. But in fact, the 10-year note actually increased today to 3.44. And Fed fund futures still implying 5%. And sitting pretty above their 50 here in the June contract, and September 481, December 441. So the Fed fund futures market is basically saying that the Fed's going to hike again in May, then they're going to pause for a few months, then they're going to cut in September and cut once or twice again before Christmas. So the bonds market's kind of saying we're going to go into a recession in either the third or fourth quarter this year. Did see treasuries come off a little bit here today, and high yield had a really big volume up day here. And the dollar looks to be losing support. You've been hearing me talk about this big support zone around 101.50. And we'll just go out to a weekly chart. This looks to be breaking down, and I think this is the third wave of a new bear trend. And a weaker dollar is generally good for stocks as it makes exports more cheaper, but it does make imports more cheaper, which is inflationary. And if you're like my clients and I who are long commodities, we want a weaker dollar as well, as commodities priced in the dollar will go up with a weaker dollar. And one of the many reasons I like commodities long term is they are priced in US dollars, which has infinite supply that we've seen over the last decade. However, there's only a finite supply of commodities, and with geopolitical tensions, a growing world population, restrictive clean energy policies, and hoarding by wealthy consumers, this all adds really strong structural tailwinds to the price of commodities that should last for many more years to come. And Bitcoin looks to be consolidating here at this $30,000 resistance level that we've been watching. And we've seen this explosive trend ever since Silicon Valley Bank went under back on the 9th and 10th of March. It's just caused Bitcoin to rocket higher. And we actually saw Ethereum break out. Nice clean break today above $2,000 on pretty strong volume as well. So these hard finite assets look to be performing really well against the US dollar, which is weakening. Commodity complex looking pretty good here today. High highs, high lows. Gold looking really good. Broke out to new highs here today. And remember last week we had the highest weekly close ever. In the 6,000 years humans have been using gold to transact and store wealth. So this is still looking good, and you can go back to my channel. I've been talking about getting bullish gold since we're below the 50 50 back here. And I continue to remain bullish on gold and have good allocation to gold in our portfolio. Silver as well, breaking out high, 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 low. Crude had a little bit of a pullback, but still holding up here. And lumber, which we just added yesterday, had a pretty good breakout here today as well. Over to stock sectors, green across the board, except real estate that came off. However, I'm not sure if I'm buying into this rally. The reason being, we've got healthcare, the defensive sectors. You look at health breaking out here, looking to walk the line like consumer staples. Utilities still holding up there strong. So typically when you see defensive stock sectors, price action like this, it's not really a bull mode rotation. This price action in defensive sectors is typically what you see going into a recession. However, with today's move and where we are right now in the markets, it's kind of a little bit mixed because we do have mega cap tech really holding things up there. And we can see that in the tech sector, kind of just consolidating up here. And another signal I would fade as well is ARK, which is full of highly valued stocks, is up 4% as well. Did see that huge move in biotech. Look at that on volume, ripping up 4.4%. And gold miners as well, breaking out, gapped up, held, closed near the highs. And financial stocks. So we got some big bank earnings coming out tomorrow, just sitting right here at the 50. So it looks like we may have put in a bottom here. That divergence played out. Still a lot weaker on the regionals though, sitting pretty flat here. Still building a divergence, and regardless with what the banks come out in their numbers, we still could get a big rip up in the financials, as sometimes the market kind of just waits for earnings to come in before repositioning. So we could still get that big pop up in regionals, as there has been signs of some accumulation down here. Over to popular stocks, and I track BlackRock every day. That's coming out with earnings tomorrow, which I'll be paying close attention to see what they're saying about the health of the stock market. JP Morgan as well is coming out with earnings tomorrow, so that should be a pretty big one. ExxonMobil sitting up there with crude. Tesla had a pretty good day, but inside bar from yesterday's big bearish engulfing, sitting under the 50 here, so still kind of undecided, tracking sideways on Tesla. Mega cap tech had a great day. Look at Apple. Big move up there on volume, but we still haven't taken out those highs from 2 weeks ago. Microsoft had a strong day as well. Amazon had a really good day. Google and Meta as well. However, what's diverging from the pack? NVDA. Green across the board, but NVDA couldn't show us any green today. And we've got a bit of a bearish divergence going on here. So that's interesting. And it looks like volume's starting to wane. So I can imagine the buyers are not really interested up at these levels, and shorts may be starting to come into the stock. However, we really need to get a close below the 50 here for the bears to be in control. Then they might be able to really flush out all these longs that have accumulated for the last 6 months in the stock. Netflix had a good day as well, up 4.5%. Meme stocks were overall up. And just a quick look at the banks here, kind of just sitting flat. So we got Citi's earnings tomorrow as well as Wells and Schwab on Monday, which is another one I'll be paying close attention to. Okay, that's a bird's eye view at all the major market categories. So let's go back to the major indices. So just looking at the global net liquidity model here, still over 150 point gap. And like I said, we're really into this big, thick resistance zone. Just going out to a weekly chart for you here. So unless we have a huge sell-off tomorrow, it looks like we're tracking for the 5th week in a row where we close higher than where we started. And that's the biggest bull run in this entire bear market. We haven't managed to put together a string of 5 green candles since this bear market begun. So I think this could be a good zone where the market stalls out. We may get a further push next week up to 4,200. Unless the Fed balance sheet starts growing again, I find it hard to see the market really pushing much higher than 4,200. We'd have to get some really good news from the banks and maybe some new inflation data showing inflation's really turning down for that to happen, and then we could possibly come up and touch our weekly buy-sell band here towards 4,300, which I'd imagine would be another good opportunity to get short. And just going through all the indices for you here, here's the NASDAQ one, kind of consolidating near its highs. And the Dow as well, got all this mess above it. Here's mid caps, really trading thick and sideways. We can see that on our range strength. And small caps as well, trading really depressed here. So doesn't look like a new bull market, just probably more of this sideways market action, in my opinion. Okay, that's all I got for you today. Thanks very much for tuning in. And if you haven't already, hit that subscribe and notifications button to get these videos every day. And I'll keep you updated on what's happening in the markets to help you make better trading and investment decisions. And don't forget to check out our equity long short strategy over on Collective too. Our portfolio is looking really good and just about hitting new all-time highs again today. All right, guys, that's it. We'll see you again tomorrow for the last day of the week with those retail sales and bank earnings. Should be a good one. See you then.